Hey everyone, George here. What I want to go over today are stock tax strategies, and some of these they're not even full-blown strategies. They're just kind of reminders to not goof up, so you don't end up paying a lot more than you should. We had a couple episodes on crypto strategies, and today we're going to do stock strategies. So let's get started. So a lot of my contractor clients put their money away into security positions, whether they're stocks, ETFs, mutual funds, what have you. And today we're going to go over 5 strategies, or some of these are kind of so small, I wouldn't even call them full-blown strategies, but they're just reminders so you don't end up paying way more than you should. So strategy number 1 is remembering the difference between short-term and long-term capital gains. If you sell positions that you've held for less than 12 months, you have to remember that you're going to end up paying short-term capital gain rates on those, which are the same as ordinary income tax rates, which can go as high as 40.8% when putting in net investment income tax and everything. Meanwhile, if you held the same positions for at least 12 months, greater than a year, then your highest possible tax bracket, including the net investment income tax rate, everything can be 23.8%. So that's the difference of 40.8% versus 23.8%. So that's quite the delta. So definitely before selling any positions, make sure you've held it for at least 12 months. Number 2, if you have a lot of gains in the current year, you should consider tax loss harvesting. So what is tax loss harvesting? So that is when you sell your positions in the current year that are in a loss position to realize the losses in the current year to offset your gains. And there are wash sale rules, which we're going to get into next. So you have to basically wait 31 days to repurchase those same positions with the proceeds from those lost sales. But in the meantime, since you've realized the losses on those positions, you can offset those against the gains. Now remember, if you have capital loss, net capital loss positions between everything, you can only offset $3,000 of losses against your ordinary income in any given year. And you can carry forward unused losses to successive years until it's swooped up completely by capital gains or until that $3,000 per year is used up. So that's tax loss harvesting. You sell your loss position securities to realize those losses and offset it against capital gains. And really it's useful to do that when you have capital gains. Now that brings us to our next point. Don't get hit by wash sales rules. So wash sales are when the IRS disallows you to utilize a certain loss, like in tax loss harvesting, if a position is sold and repurchased within a 30-day period. So you have to wait 31 days to repurchase your positions in order to offset those capital gains with realized loss position. So again, if you sell a stock at a loss and repurchase those positions, in a couple days, the IRS disallows you to use that loss, and it shows up in its own box, disallowed wash sale, amounts on your 1099 that's issued by a brokerage. So again, you will have to wait 31 days to be able to use those losses. Now we got lucky in that crypto is viewed as property and not securities. So cryptos are exempt from wash sales rules. So that is definitely a big advantage with cryptos. Number 4 strategy is use your family members' lower tax brackets to the extent that you can. So you can gift appreciated stock to family members in lower tax brackets, and assuming this is somebody you trust, like, somebody you have a great relationship with, your kids, your parents. So for example, you can gift your appreciated stock to your children, and let's say they have no income whatsoever. That's the only potential income they would have if they sold those gifted positions. And they sold those positions at a gain. Now they'll end up paying taxes at between a 0 to 15% bracket, potentially, tax bracket, versus your tax bracket, which could be as high as, again, 37%, 40.8%. So as a reminder, you can gift up to $19,000 per recipient, and if you do it with a spouse, up to $38,000 per recipient. And it would not trigger any gift tax filings. It would not trigger any tax liability on anyone's end. It's pretty much completely excluded and under the radar. So you can gift with your spouse up to $38,000, have your children potentially sell that position, or a retired parent, either way, and they would pay tax at a much lower tax bracket than potentially yourself. And number 5 stock strategy is avoid giving a charitable donation with a stock in a loss position. What you're going to want to do is first sell that position, redeem it, and realize your loss on your personal level, and then gift the cash from the proceeds of that stock. Now you can go ahead and donate appreciated stock, because that really works out to your advantage, where you avoid the capital gains entirely and you get a deduction at the fair value of what the stock was. However, if you were to donate stock that's in a loss position, what would end up happening is you lose the possible deduction for the losses, the realized losses, and you end up only being able to deduct what the fair value was at the date of donation. So if you're going to donate stock, make sure it's either at an appreciated position or redeem it first, realize those losses, and then donate. And there's also one sub strategy that comes with this is if you have a lot of gains, consider putting it in a CRT, so that way you defer the gain entirely. It goes in the CRT, and then you take a 5 to 7% draw from that CRT every single year until the positions are fully relinquished, and you only include in income the 5 to 7% over the years that you're actually receiving it from the CRT. So you end up deferring the whole gain into years at a much smaller amount per year. So potentially, and if those stock did keep appreciating while in the CRT, it would serve you longer as income. So effectively, you're getting taxed at lower rate per year that you're getting that appreciation. So again, our 5 tax strategies with respect to stock are, again, wait at least 12 months until you sell a position. Otherwise, you're going to pay, assuming that you're in a gain, or otherwise you're going to pay significantly higher tax. Consider tax loss harvesting, which is using loss position stocks to realize that loss in the current year to offset any realized gains you have in that year. Don't get hit by wash sale rules. If you're going to do tax loss harvesting, you have to remember, right? You have to wait at least 31 days to repurchase the positions to be able to utilize those losses. Consider moving the stock, gifting it to a family member that you trust at a lower tax bracket, and having them realize the gains. Needless to say, you'd need to cover the tax related to those gains for them, but it would be at a much lower tax bracket. And don't donate stocks with losses. Always, if you're going to donate stock to charity, make sure it's appreciated stock. If it's a stock that's in a loss position, its fair value is less than what you bought it at, make sure you sell that stock, realize that loss position for yourself, and then donate the proceeds, because that's all you're going to be able to deduct anyway, and that's all benefit that the charity will get. So I hope you found this helpful. Click like, subscribe, turn on notifications for any updates, and hope to see you in the next one.